Jordan, good to see you. We're getting back to basics today. 3 RMD strategies to reduce your tax burden. We've all heard of them, but let's break it down from the top. What are required minimum distributions and how are they calculated?
Yeah, so the government, when you reach a certain age, they force you to take money out of your IRAs or 401ks because they want you to enjoy life. They want you to travel. They want you to, spend money on your family. Well, not 100% true. They actually want the revenue from that. So they
Yeah.
force you to take distributions out, as you can see in the chart, based on your age. And if those years based on your date of birth, they force you to take money out to pay the taxes on that. And they calculate that December 31st of all of your qualified accounts the year prior. And then based on the age, you're then forced to take out a distribution that next year.
And you make sure your clients take those distributions when they need to, because if they don't, there's a pretty stiff penalty.
Yeah, the government does actually care if you forget or don't take it out. And not only will they force you to take it out later and pay taxes on that, they also will impose a penalty on that. Now, the good news is it used to be 50%. The bad news is it's now 25%. Oh, and it gets better. If you correct it within 2 years after forgetting, it's only 10%. But we want to advise and have a plan that you never forget to take those required minimum distributions, and maybe we can even minimize or eliminate them with good planning.
All right, so now let's get into those 3 strategies. The first strategy would be start taking those distributions as early as possible, which is 59 and a half, before you are required to do so.
Yeah, you can start minimizing your IRA balance, be 59 and a half, because you know that 10% IRS penalty, but you also got to coordinate that with your overall plan, because if you're still working and have wages, it may not be in your best interest or advantageous to take out IRA distributions while you still might have wages. So it could be an option, but it does not apply to everyone, but that's why the plan is so important.
And then next we have a strategy you and I have talked about often, Jordan, Roth conversions.
Yeah, so for people that maybe want to take advantage of these historically low tax rates, they can shift money from their IRAs to a Roth IRA and pay the taxes while they're on sale. And then once it's in a Roth IRA, as we see in that chart, it's going to be tax-free forever. So it's a great way to look at your overall tax plan. Maybe you have some wiggle room inside your tax brackets that you can kind of do some Roth conversions and fill up that bracket. So then you can shift it to out of the IRS's control and back into your control. And generally speaking, you're usually more aggressive after you do that on the Roth side, because say it's $100,000 hypothetically, if that grows to $1 million, 100% that's tax-free if it's already in a Roth.
And then last, we have a strategy that I really love. It's a win-win for everyone, a qualified charitable distribution. How does this work?
Yeah, so say you love giving a charity no matter what, and you give X amount to a charity per year. If you have any IRA funds and you have reached the age of 70 and a half, you can send funds from your IRA custodian directly to that charity. Now, that classifies as a QCD, a qualified charitable donation. A couple words of caution, though. If you take that money and put it in your checking account and then give it to the charity, that does not classify, and you're going to be fully taxed on that distribution. Yeah. Or maybe you do everything correct and you send it from that custodian to the charity, but your financial advisor and your tax accountant are not coordinating together and communicating. They may not code that correctly as a QCD, and you still might be taxed on that. Now, if you are at that about to be RMD age, I'll give you one little bonus strategy. Say you want to leave money to your children. Say you want to pay less in taxes, and you still want some income from that. You can actually do a charitable trust where you get a huge tax deduction. You can still get income from that trust. Oh, and by the way, that income for those RMDs, they can funnel up to a life insurance that'll pay to the next generation as well. So you get the best of all 3 worlds if you have a plan.
Right. And then just to kind of underscore, this all comes back to strategic tax planning. RMDs specifically are tricky for retirees because their income, which comes back to something we've said before, you may not be in a lower tax bracket when you retire.
Yeah, the RMDs maybe done so well in your investments and it's grown and you thought you're going to be a lower tax bracket in retirement. Well, what if a few things happen? What if you lose a spouse? Your tax rate's effectively double because you have to go to a single filing. Or maybe you have so much income from that RMD that pushes you into higher tax brackets or extra IRMA costs. So everything is a domino effect. So you need to look at this not when you're 73 or 75, but look at it beforehand. How do you plan around that to minimize, reduce, or eliminate those RMDs.
Right. And just to remind everybody, you and I have separate videos on Roth conversions and QCDs and a lot of other tax planning strategies on your YouTube page so that people can watch it at their leisure. But if somebody does want to talk this through, and again, the sooner kind of they have that conversation, the better, what's the best way to get a hold of you?
Yeah, they can reach out to our main number, 847-499-3454, and we can hopefully minimize, reduce, or eliminate those RMDs.
I love it. Jordan, thank you.
Thanks, Aaron.